The stock market has smashed one record after another, gaining $8 trillion and more in value in just this short period of time. The great news for Americans, 401k, retirement pension, and college savings accounts have gone through the roof.
That was President Trump last night touting America's market milestones since he's taken office during his State of the Union last night. Futures this morning are bouncing after 2 days of heavy selling. Take a look. We're expecting a gain at the start of trading after the Dow tumbled 363 points yesterday, the worst day since May. Joining us right now is Scott Wren, Senior Global Equity Strategist with Wells Fargo Investment Institute. Scott, it's good to see you. Thank you so much for joining us this morning.
Hi, Maria. How are you?
It's good. So first, let's talk about the sell-off that we've seen in the last 2 days. What is behind this heavy selling from your standpoint?
Well, I tell you, it was funny because just you look at the headlines, people are trying to, it was kind of a blame game the last couple of days, and a lot of people attribute it to rising rates, which I completely don't agree with, or, what's the president going to say, and I don't think that had anything to do with it. I think most of the reason why we had a sell-off was because from right before Christmas until last Friday, the market, S&P 500, was up almost 12%. It was a completely vertical move, and whenever that happens, you're going to get some volatility to the downside at some point, and I think that's all we saw. We saw a little bit of selling, people taking some money off the table. I think from the low yesterday, we're still not even down 2% from the high. So I think this is the kind of volatility that we should expect in 2018. And really, to be honest with you, for retail investors, still with cash on the sidelines, which there's plenty of those, you have a 5-7% pullback. That's nothing but an opportunity. And if I was a retail investor, I'd be hoping that we see a little bit more downside.
Dagan, we talked about this yesterday. After a $7.5 trillion in gains from the election in terms of market value, people look for an excuse to sort of lighten up.
Right, risk appetite at a record high by some measures. The price to earnings ratio, the median for all stocks on the New York Stock Exchange, NASDAQ, and AMEX at a record high as well. Due for a pullback indeed. And going into this new year, we've been talking about this literally every day, that you have to watch bond yields, that if you have an economy that is picking up steam moving into the new year, JP Morgan's CEO, Jamie Dimon, telling you he sees 4% is easily doable here. You have to worry about what kind of headwind rising yields will be. Near a 4-year high yesterday, closed the 10-year yield hit 2.725%. Not that this is bad news if the yields are going up because the economy is doing better, but nevertheless, that could be a drag on stocks.
Yeah, it's a good point. What about you, Scott? You said you don't believe that it's interest rates a minute ago. You're not worried about higher rates? What's your magic number that actually would push you to tell clients, okay, lighten up on stocks because rates are becoming more competitive?
Well, I think, Dagan was right. Typically when you're coming out of a recession and the economy's accelerating, rates are rising, inflation's going up a little bit, the market loves that. It's a sign of things accelerating. But really, if you look at it, Maria, from the high in December, which was about 250 on the 10-year, we're really only about 20 basis points higher. So I don't view that as a large move. I think if you start to move north of 3% and you don't get we're looking for 2.9% GDP this year, which, is a lot better than what we've seen lately. I think in that kind of an acceleration, you can justify higher rates in the bond market reflecting higher rates. But I still think that it's highly likely that at some point here the Fed makes a mistake. We're calling for 2 rate hikes here this year. The Fed's saying they're going to do 2 or 3. The market can digest that.
So that's what you think.
But 4,
then that's what you think is going to be the
problem.
Catalyst then for a sell-off. The Fed.
I think it could.
Going overboard. We should point out that today is the Federal Reserve Chairman Janet Yellen's final policy meeting as head of the central bank. So we'll see what she has to say at the end of today's meeting. But you think there's a real chance they could blow it in this year with too many rate increases?
Maria, you look over the last 30 years. The ebb and flow of the economy is caused by, on the upside, the Fed leaves rates too high for too long. They hike them too quick, and it's a headwind, and we roll over. That's what happens virtually in every cycle, and I think that's a high probability this year. I think the tax cuts have the potential potential to extend this expansion for probably a couple more years. And I think this year is going to be a lot about global central banks. What are they going to do? How much tighter are they going to get? You know, if we're wrong and let's say GDP's north of 3% and inflation stays low, we're probably too conservative. But if, you know, the Fed can spoil the party, this is a big year to see what the Fed's going to do, the ECB. You know, we got to watch central banks this year.
All right, we'll do that. Monetary policy going away, fiscal policy taking front and center. Scott, thank you. Thanks very much.
All right,
Scott
guys,
Wren
have a
joining us
great
there.
day.
And to you.